This is, I agree, what's causing a lot of these problems. The dollar is a safety currency. It's the currency to which people flee when they're unhappy with their own currencies, with their own economies. And so despite the massive deficits, the trillion-dollar deficits, the very low interest rates, the prospect for more inflation, the dollar continues to be very strong. And that has all kinds of implications. It is tough on trade. So far, it means that more money is coming into the U.S., which keeps interest rates low. Right. But it's a two-edged sword.
Right. And so in other words, from the president's point of view, because he's talked about this quite a lot, you would say to him, look, yes, the dollar is strong, but the flip side of that is you're getting lower interest rates than we would otherwise?
Absolutely. I mean, that's how we're able to fund this $22 trillion deficit that we have. Because interest rates are so low, it is a vote of confidence from the rest of the world in the U.S. economy, in the U.S. government. Things could get ugly if people lost that confidence and interest rates started to go up. It'd be very tough to finance $22 trillion.
Michael, are U.S. interest rates artificially low right now, or are they too high?
Wouldn't really say artificially low, and it's interesting when you think about the U.S. being a safe haven. Some of that makes sense, but perhaps the other part is people around the world look around and say, well, okay, you've got German yields at minus 70 or 80 or some crazy number. Yields in France are terrible. Yields in the UK are bad. The U.S. is about the only place to go for yields. I'm not so sure it's a vote of confidence so much as where else will we put our money.
A desperation shift.
Right.
No, it definitely doesn't seem like a great sign. But people have been hounding the Fed to cut interest rates. Is that warranted in your view, especially now in light of the data this morning, U.S. manufacturing, the ISM survey dropping into contraction?
Big challenge for the Fed as far as we're concerned is trying to bridge the gap between what the market expects, which is another 4 cuts really, and what the Fed has been signaling, which is 1 or maybe 2. Now at Jackson Hole, Chairman Powell did not choose to bridge that gap, but guess what? Donald Trump's been able to ease a lot more aggressively than the Fed. When the Fed doesn't do what he wants, the president steps in. So the Fed's got a very tough spot. We think, bottom line, the Fed does not need to ease as much as the market expects.
And bottom line, the 10-year Treasury is going where then, Michael?
Oh, boy. Over the next month or two, we think it's just about anywhere. Now, if you say, well, okay, let's take a 12-month view, perhaps higher, but think about the scenarios that might unfold over the next few weeks. You've got a trade battle, the UK Brexit, the Hong Kong situation, a hurricane, too many variables to try and handicap in the near term. Our advice is keep it safe over the next month or two.